Welcome. This is Argo Perspectives, a podcast about deals, sustainability, and profits with purpose. We are Argo Advisory, a boutique advisory firm. For inquiries, reach us at office@argo-advisory.com. From boardroom battles to everyday deals, here is how managers buy the business they run, using leverage, discipline, and a surprisingly small amount of their own cash. How managers buy their own business. In October 1988, a man named Ross Johnson walked into a board meeting at RJR Nabisco, one of the largest consumer goods companies in America, owner of Oreo cookies, Ritz crackers, and Camel cigarettes, and proposed something almost no one in the room had expected. He wanted to buy the company. Not with shareholders' money, with borrowed money. His own team would put in a slice of equity. Banks would lend the bulk, and the business's own future profits would repay the debt. What followed was 6 weeks of the most ferocious corporate bidding war in history. The private equity firm KKR eventually won with an offer of around $25 billion. Now, to put that number in perspective, RJR Nabisco at the time had an operating profit of around $2 billion. The winning bid was around 12 times those of operating profits. And the vast majority of it was not in cash. It was debt layered on top of debt, all ultimately serviced by the future earnings of the business itself. The whole thing was made possible not by the size of the KKR's wallet, but by the structure. Most management buyouts are not $25 billion wars fought in Manhattan boardrooms. Most are quieter, smaller, and far more achievable than that story suggests. But the logic is identical, and today we're going to break it down properly. How the money actually works, who gets to do this, and what the real risk looks like from the inside. A management buyout is when an existing management team of a company acquires that business from its current owner, using a combination of their own equity, bank debt, and usually private equity backing. The management teams are not the majority financiers. They are the operators. They bring the knowledge, continuity, and a credible plan. The financial backers bring the capital. The best way to understand the mechanics is through a mortgage. You want to buy a house with £500,000, you put $50,000 of your own money in it, 10%. The bank lends you the remaining 90%. You pay that loan back over 25 years from your monthly salary. Now here's the interesting part. You own 100% of the asset from the day one, but you only contributed 10% of its value in cash. If the house doubles in price to £1 million, your $50,000 has turned into $500,000. Because the gain applies to the whole asset, not just your deposit. That is a 10 times return on your cash from a 2 times increase in the underlying value. That is what leverage does. And that same principle applied to a business instead of a house is the engine that makes the management buyout model work, the MBO. In a typical MBO, the capital sits in 3 layers. Think of it as a pyramid. At the base sits senior bank debt, the cheapest money available, secured against the assets and cash flows of the business. The bank typically funds 50 to 60% of the purchase price. Because the bank is first in line to be repaid if anything goes wrong, their risk is lower, and so is their required return. They charge interest, modest, relative to the other layers, and they want their principal back on the defined schedule, usually over 5 to 7 years. In the middle layer sits private equity. They fund roughly 40% of the deal. They sit behind the bank in repayment priority, and if the business struggles, the bank gets paid first. Because their risk is higher, they demand more than interest. They take equity. Their return does not come from the coupon payments. It comes from owning a share of the business, especially when it's sold. And at the very top of the pyramid, the thinnest slide is the management team, typically up to 10% of the total value. The smallest cash contribution, the most junior in the repayment queue, and the greatest proportional upside of anyone in the structure. Let me run the numbers so that it is concrete. A business is acquired for £15 million. The bank provides £10 million in debt. The private equity puts in £4.25 million as a loan stock. Essentially, a high-interest loan that gets repaid before an equity distribution, plus $300,000 in ordinary shares for 40% of the equity. Management invests £450,000 for the remaining 60%. So on day one, management have paid £450,000 and own 60% of a £15 million business. Wind the clock forward 5 years. The team has run the business competently, no dramatic transformation, just steady trading and disciplined cash management. The business has paid down £6 million of the original bank debt. It has grown modestly and now valued at £20 million. To calculate what management's stake is worth, you work down the pyramid from top to the bottom. The remaining bank debt, $4 million, gets paid first. Then the private equity loan stock of the $4.25 million, that leaves $11.75 million of equity value. Management owns 60% of that, £7 million. On a £450,000 investment made 5 years earlier. That is a 15 times cash return, not from a high growth technology business, not from a turnaround, but from running a stable, cash flow generating business and letting the debt repayment compound silently in the background. That is the MBO model. Who actually gets to be in the management team in one of these deals? What do the financiers need to see before they back you? 3 things. First, completeness. Every critical function needs to be covered. A chief executive with the full profit and loss responsibility, a finance director who can manage the debt covenants, the monthly reporting pack, and the relationship with the bank. A sales lead, the operational lead. If the team has a gap, an external manager can be recruited to fill it in. A hybrid structure industry calls a buy-in management buyout, or BIMBO. Not a flattering acronym, but a legitimate and frequently used solution. Second, track record. The business's historical performance is the primary evidence of competence. Financiers are not underwriting your projections. They're underwriting your history. What have revenues and margins done over the past 3 years under your watch? That's the question. Third, and this is the one people are often surprised by, personal investment. Every manager in the team is expected to put their own money in. The rule of thumb is approximately 1 year's gross salary per person. Banks will often lend against this specifically, so it does not have to be liquid savings, but the money has to be genuinely at risk. The industry calls this, with characteristic bluntness, hurt money. It exists not because the management's cash is structurally important. It really isn't, relative to the banks and PE's tranches. It exists because a manager with £400,000 of personal capital in the deal makes different solutions under pressure than one who simply draws salary. On a business side, the ideal MBO candidate is profitable, generates reliable and predictable cash flows, and can operate independently. The last point is particularly important when a business is being carved out of the larger corporation. Once the parent's IT systems, HR function, and the central finance team are removed, can this business stand on its own? And critically, can it service the deal debt even in a bad year, which is where the real risk in the model lives? In 1989, at the peak of the British buyout boom, a kitchen manufacturer called Magnet completed one of the most celebrated management buyouts in the United Kingdom. The business was market-leading, well-run, and genuinely profitable. The deal was structured with substantial debt. The logic was straightforward. Magnet generated strong cash flows. The debt could comfortably be serviced. The projections showed it clearly. Then the housing market collapsed. Magnet's revenues were almost entirely dependent on the home purchases and kitchen renovations, both of which evaporate when property transactions stop. The UK government raised interest rates sharply in 1989 to defend sterling's position in the exchange rate mechanism. Rates briefly hit 15%. The housing market froze almost overnight. Magnet's revenues fell sharply and kept falling. But the debt service obligations did not adjust. The monthly repayments to the bank were fixed, contractual, and entirely indifferent to what was happening in the housing market. Within a year, Magnet was in administration. The business was not fundamentally broken. The management team were not incompetent. The deal structure had simply been sized against an optimistic end of the revenue range, with no buffer for sustained downturn. The lesson, and it is the most important practical lesson in the entire MBO model, is that the debt has to be serviceable not in your base case, but in the scenario where the revenues fall 20 or 30% and stay there for 2 years. If the structure cannot survive this stress test on paper, you either reduce the purchase price, reduce the debt, or you do not do the deal. There is one final thing worth understanding, because it changes how you approach the whole process. Vendors often actively prefer a management buyout over a trade sale. A competitor or strategic acquirer brings months of due diligence, confidentiality risk, and real possibility that business gets absorbed, restructured, or stripped for parts. A management team knows this business already. They need fewer legal warranties. They can move faster. And for a founder who has spent decades building something, handing keys to the people that they worked alongside for years is worth something that does not show up in the price. Many vendors will not even run a competitive auction if the management team makes a fair offer. That is a structural advantage worth understanding before you decide whether to approach. The whole process from first conversation to completion typically takes around 6 months. A financial advisor runs a feasibility study before anyone approaches the vendor. A business plan is built and presented to banks and PE firms. Heads of terms are agreed, due diligence runs, legal documents are drafted, and new holding companies are incorporated to make the acquisition. Advisory fees run roughly 5% of the deal value, typically contingent on completion, funded from the deal itself. And then the deal closes, which is not the end. It is the moment the real job begins. The debt is live. The PE clock is running. Your investors will need to realize their returns within 3 to 6 years. From day one, the business needs to be shaped towards an exit, a trade sale, a stock market listing, a secondary buyout, or a refinancing. The management teams who do this well are the ones who treat the exit not as an afterthought, but as a strategic objective they have been working towards since the morning after completion. The management buyout is more accessible than most people assume, less complicated than it first appears, and more dependent on the execution discipline than on financial engineering. If you know your business better than any outside buyer ever could, that knowledge is worth something. The MBO is the structure that lets you convert it. This is it for today.